Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Jet.AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine this scenario for a second.
Okay, I'm listening.
A company reports its quarterly earnings.
Yeah.
Right. And the sales completely miss expectations.
Like a total miss.
Exactly. The losses per share jump by over 34% year over year.
Yeah.
I mean, by all traditional Wall Street metrics, this stock should be an absolute crater.
Yeah, you would expect the market to just punish it instantly.
Right. But you look at the pre-market activity today, and the stock is seeing this massive momentum. I mean, it is just surging.
Buyers are stepping in with serious conviction.
Yeah. It's a profound financial paradox. How does a microcap company post an incredibly ugly quarter and then instantly become, one of the most hyped active stocks on the board?
That paradox is exactly the core of our analysis today. We are breaking down this really radical corporate pivot. Jet.AI is moving away from its legacy operations like private aviation and going completely all in on high-margin AI and GPU infrastructure.
Which is a huge jump.
It is. And we need to dissect this genuinely jaw-dropping $5 million share buyback that management just announced.
Right. We definitely had to get into that.
Yeah, and ultimately determine if this microcap is positioning itself as, a solid 7 out of 10 bullish swing trade for your portfolio.
Okay, so before we can even begin to understand the hype driving the stock today, we have to look at the massive fundamental transition that's forcing this company to evolve.
The growing pains.
Exactly, the growing pains. Because you really have to look at the raw numbers from their fourth quarter to appreciate how jarring this looks on paper.
Oh, it's brutal on paper.
It really is. They recently reported fourth quarter sales of $1.766 million. The street was expecting $2.1 million.
So they missed on the top line.
Big time. And earnings per share came in at negative $2.50. The consensus was looking for negative 68 cents.
Right, which represents a 34.38% increase in losses compared to the prior year.
Wow.
Yeah, where they were at negative $3.81 per share. So profit margins are under severe pressure right now. And the filings attribute this directly to, quote, aviation transition costs.
Okay, let me stop you there. Because transition costs sounds a lot like corporate speak for we are losing money.
It's a very polite way of putting it, yeah.
Right. So let's look at what they are actually transitioning away from. They're planning to divest their lower margin jet card and fractional business to a company called Fly Exclusive.
Which is a major move.
It is. And for anyone unfamiliar, a fractional aviation business is essentially a timeshare for private jets.
Right, you buy a share of a plane.
Exactly. You buy a share, you get a certain number of flight hours. But running that is an absolute logistical nightmare.
The overhead is insane.
You are paying for jet fuel, hangar fees, constant mechanical maintenance.
Pilot salaries.
Right. Pilot salaries. It's an incredibly capital-intensive business that just bleeds cash.
Yeah, and by divesting that segment, they are actively amputating the most expensive part of themselves.
Right.
It's not that their core business just suddenly forgot how to operate efficiently. They are looking at the math and realizing that traditional aviation overhead is a trap.
Okay, so it's a calculated loss.
Exactly. The transition costs, pushing their earnings into the negative, that's just the price of admission for getting out of a heavy asset industry.
And moving into a sector where the margins are exponentially higher.
Precisely. Data centers and software as a service.
I hear that, but I have to play devil's advocate for the listener here.
Go for it.
It's like remodeling a house while you're still living in it, right? It's messy, it's expensive, and it is highly stressful.
Very stressful.
So are the bleeding transition costs of the aviation side overshadowing a legitimately lucrative future in AI? Or are they just pivoting to the hottest buzzword on the market because their main business is failing?
That's the million-dollar question.
Right, because it's very easy for a struggling microcap to slap the letters A and I on their website to, artificially pump their stock. Are the fundamental cracks too deep to fix?
Well, right now, you are looking at a snapshot of a company mid-metamorphosis. The revenue they are still generating is actually coming from their high-growth segments.
Oh, really?
Yeah. Their software applications and gross charters booked via their AI platforms, those are still functioning.
Okay, so the core tech is working.
Exactly.
Hmm.
The underlying engine they want to keep is working. The losses are deliberate restructuring. They are shutting down the legacy furnace, basically, to install a vastly more efficient system.
Okay, so to figure out if this pivot is actually worth the pain, we need to examine what they are replacing those planes with.
Let's talk about their competitive moat.
Yeah, because on the surface, an aviation company building data centers sounds bizarre.
It sounds completely random.
Right, but they're combining AI-powered software intellectual property with shovel-ready data center sites. On the software side, they built tools like CharterGPT for bookings, DynoFlight for carbon tracking, and advanced fleet positioning intelligence.
And the connection between those two things, aviation software and AI data centers, is like the most crucial piece of this entire puzzle.
How so?
Well, think about what managing a fleet of private jets actually entails.
Okay.
It is fundamentally a massive logistical optimization problem.
Oh, I see.
Right. You have to route depreciating physical assets across the globe. You calculate fuel burn rates, manage carbon offsets, predict maintenance schedules, all based on environmental variables.
That's a ton of data.
Exactly. Jet.AI built complex natural language processing technology, CharterGPT, specifically to solve those brutal logistics.
Okay, I see where this is going. Managing a hyperscale GPU cluster is also a massive logistical optimization problem.
Completely. Instead of routing physical planes, you are routing colossal data sets. Instead of managing jet fuel, you're managing megawatts of power draw. Instead of calculating altitude physics, you are calculating thermal output and cooling efficiency so your servers don't literally melt.
That is fascinating. So they looked at the mathematical engine they built for planes?
And realized the code itself is incredibly valuable. The planes were the problem.
Wow.
Yeah, so they are taking that proprietary logistical brain and applying it to an asset that is appreciating in value, AI servers.
That actually makes the software side click for me.
Let's look at the physical infrastructure side then.
Okay.
They are developing power-rich hyperscale campuses through joint ventures. They have partnerships with entities like Convergence Compute and Choo-Choo Express in the Midwest and Maritime Canada.
Right.
But more importantly, they are targeting a massive 50-megawatt data center in Moapa, Nevada.
And they're doing this by leveraging existing power and fiber assets.
Which creates high switching costs. I get it. It protects them against traditional brokers like Wheels Up on one side and pure AI players like CoreWeave on the other. Exactly. It's a dual approach.
But I am going to push back hard on this strategy.
Okay, let's hear it.
Trying to beat traditional aviation brokers and specialized AI infrastructure giants at the same time seems like spreading a microcap dangerously thin.
That's a fair point.
I mean, a 50-megawatt data center is not a small project. That is enough electricity to power a small city.
It is huge.
Leveraging existing power lines sounds great in a press release, but CoreWeave and big tech companies have billions in their war chests. How do they actually fund and execute this without getting crushed by bigger players?
Well, you are touching on the exact skepticism any smart investor should have when looking at a microcap playing in the hyperscaler sandbox.
Right, because they can just be outspent.
But you are underestimating the current global bottleneck in artificial intelligence. Grid power. The bottleneck is no longer getting your hands on the GPU chips. The bottleneck is literally electricity.
Oh, wow.
Yeah, you cannot just buy the plot of land next door if the local electrical substation is completely maxed out.
So the power grid literally cannot support it.
It can't. The grid cannot support it, and the permitting process to upgrade that grid or build a new substation takes years, sometimes up to a decade in certain municipalities. Jet.AI's shortcut is finding specific sites, like Moapa, that already have the power substations and the fiber optic lines laid out and approved.
So they are skipping the line.
Exactly. They bypass years of bureaucratic permitting and hundreds of millions in foundational infrastructure costs.
That's huge.
They bring the shovel-ready site and the optimization software, and their joint venture partners bring the massive capital required to actually buy the computing hardware.
So they don't even have to front the hundreds of millions for the servers themselves.
Right. They blend their aviation-originated technology with GPU infrastructure development. A pure aviation broker doesn't have the technical ability or the real estate to compete.
And a pure AI player isn't going to spend years developing specialized carbon tracking algorithms.
Exactly.
Yeah.
Jet.AI has carved out a very specific, defensible intersection.
Which brings us to the financial catalyst that has the market entirely captivated today.
The buyback.
Yes, because my concern about funding is exactly why the market's recent reaction is so fascinating.
Hmm.
When a company is transitioning out of a heavy industry, burning cash, and staring down the barrel of infrastructure projects, the market generally assumes one thing.
Dilution.
Exactly, dilution. They assume the company will need to issue millions of new shares to raise cash, which devalues the stock.
And that assumption acts like blood in the water for short sellers.
Oh, absolutely. They start betting against the company and driving the price down. But this is where the story gets wild. Just when you would expect dilution fears to tank the stock, the board approved a massive $5 million share repurchase plan.
Yeah, that is not a typo.
We have to put those numbers in context for you so you understand the scale of this move.
Please do.
Jet.AI is a microcap. Their total market capitalization has recently been hovering somewhere between $4.6 million and $11.8 million.
Let the math on that sink in.
They only have roughly 45.48 million shares outstanding. A $5 million buyback on a company whose entire market cap might only be double that amount.
It is staggering.
It's insane. While they have a low debt load, they have limited liquidity and negative free cash flow because of the heavy capital expenditures for this AI pivot.
Right.
If you were generating negative cash flow, allocating $5 million to buybacks feels reckless at first glance.
It definitely looks like a gamble.
It's like maxing out a credit card to buy a Rolex because you know you're getting a promotion tomorrow.
That's a great analogy. Or like a farmer who takes on debt to buy his neighbor's land, but instead of buying a tractor, he uses his last bit of cash to buy back his own farm's stock.
Exactly.
It signals to the entire town that he knows exactly what is buried under his soil, and he wants to own every inch of it before anyone else figures it out.
So it's extreme insider confidence.
It is the ultimate flex of corporate confidence. By announcing a buyback of that magnitude relative to their size, the board is weaponizing their available capital to shock the market's psychology.
But is it brilliant? Or is it a risky allocation of capital that should be going toward those Moapa data center bills?
It is a calculated squeeze on the short sellers.
Okay.
The board is telling the market that their stock is so fundamentally mispriced relative to the joint venture milestones they're about to hit that the absolute best return on their cash right now isn't buying another server.
It's buying their own equity.
Yes! It instantly removes the immediate fear of dilution.
Which explains the market reaction we saw today. Headlines noting the stock was most active and trading higher.
Volume surges. Breakout momentum.
The selling pressure simply evaporates because the company itself is standing underneath the stock with a massive safety net.
Exactly. Strong buyer conviction just overpowers the bearish fourth quarter sentiment.
Institutional flow steps in because the risk of getting diluted into oblivion is suddenly off the table.
It shifts the entire narrative from, look at these terrible aviation losses, to look at this aggressive, confident AI turnaround.
Okay, so with that buyback igniting the stock, we need to map out what the next few months actually look like for your portfolio.
The playbook.
Right. How do you trade this momentum? Based on the data, the optimal target horizon here is a swing trade into the first quarter 2026 earnings.
Which are expected in late May or early June.
If you're making this 3 to 6 month swing trade, what are the specific catalysts you need to watch between now and then?
You are looking for concrete updates on the Moapa 50-megawatt joint venture milestones.
Okay.
You are looking for verifiable progress on those hyperscale campuses in Canada and appearances at major industry AI conferences.
And there's even unconfirmed speculation floating around that hitting these specific infrastructure milestones could spark M&A interest, right?
Yeah, mergers and acquisitions from larger AI hyperscalers who just want to buy the power access.
Because power is the bottleneck.
Exactly. We also have to factor in the macro tailwinds pushing from behind. The broader market is in the middle of a historic AI capital expenditure boom.
Every major tech company is desperately hunting for infrastructure.
And as sector rotation happens, capital is moving out of the massive mega cap tech stocks and looking for high upside, high growth opportunities in small cap tech and data centers.
And Jet.AI is sitting directly in the path of that capital rotation.
Provided they execute on their blueprints.
Execution is the key word there. We have to thoroughly examine the bear case. As a microcap, they remain vulnerable.
Very vulnerable.
The major risks here are execution and funding gaps. The buyback currently prices in a turnaround and acts as a buffer against dilution fears today, but they still have to physically build the things they say they're going to build.
Right. Financial engineering does not pour concrete.
Exactly. So what is the exact canary in the coal mine metric you are watching? What specific update tells you this grand pivot is failing and it's time to get out?
The absolute canary in the coal mine is silence on the joint ventures.
Silence.
Yes. In the physical infrastructure world, progress is highly visible and heavily documented.
That makes sense.
You secure a municipal permit, you announce it. You finalize a hardware procurement contract for cooling systems, you announce it. You break ground, you announce it.
So if late May rolls around, right before those Q1 2026 earnings, and we haven't seen definitive, verifiable progress on laying fiber or securing substations or deploying GPUs, what then?
If the updates become vague, or if timelines start getting pushed back in the press releases, that is your exit signal.
Okay.
The $5 million buyback buys them incredible goodwill today, but if the execution timeline slips, the funding gap for a microcap becomes a massive liability.
The joint venture partners could get cold feet.
Exactly. And if the partners pull their capital, Jet.AI is left holding a shovel-ready dirt lot with no money to build. That is when the trade breaks down.
Bring all these complex threads together for us. What is the final verdict on Jet.AI for the wealth-building listener?
The final investment thesis gives Jet.AI a 7 out of 10 bullish score as a swing trade. Here is the distilled case. Jet.AI is leveraging a shocking $5 million buyback and a radical pivot toward high-moat GPU data centers to fuel a corporate turnaround.
By intentionally shedding their low-more-end aviation business.
Yes, and leaning into power-rich infrastructure partnerships, making it a highly compelling AI upside play in a CapEx-hungry market.
Yeah.
You are buying the momentum of the buyback and holding for the joint venture catalysts over the next 3 to 6 months.
It is a fascinating transformation to watch unfold.
Yeah.
You are essentially seeing a company shed its skin and rewrite its own DNA in real time on the public market.
It really is unique.
Which leaves you with a final lingering question to ponder as you evaluate your own portfolio this week. If a private jet booking company can successfully pivot into the highly lucrative world of hyperscale GPU data centers simply by leveraging its existing software and power assets, what other traditional capital-intensive businesses are out there quietly sitting on massive, undiscovered AI infrastructure gold mines?